some of these products are on minimum 20% tariffs all the way up to like 35.
It's been a bumpy summer for retail stocks, largely due to the impact of tariffs.
You haven't even seen the gross margin impact yet.
Hill Davis with Digital Brands Group shares what investors need to know about the retail sector.
I think you're going to see a lot of fallout over the next 6, 9, and 12 months.
And what some retailers are doing to pivot and keep their business growing strong.
We're going direct, and then we're able to drive this incredible value proposition.
Could tariffs change the retail game entirely? Let's dive in. Hill, so great to have you with us today. We're excited for this conversation about the retail sector. It's not one we cover a whole lot on this channel, but there's a lot that's been happening over the last few months, at least, in the retail sector. So give us an update. Overall, has it been a really strong summer for retail?
Yeah, I think it's actually been a very mixed summer for retail. I think you're finding that anybody who has a strong value message tends to be doing well. The luxury brands are okay, but they're losing their kind of the low end of their customer base that were buying the trinkets. So you'll see their numbers haven't been as great. The ones that have tended to do better are either really on trend with like what's happening, or they have a value play. So the middle kind of continues to get squeezed a little bit. And then the ones who either are really on trend fashion-wise or have a strong value message tend to be performing better than the others.
Yeah, I think we're definitely seeing that with earnings season that just wrapped up. We're seeing those value brands doing really, really well right now. And then some of those more luxury brands not as well. So the great overview of what's happening in retail. I want to talk about online retail too versus brick and mortar, the big store, the big box stores that we see. Is there a big difference between those two different kinds of companies too?
I think you're seeing not as much there. I think what you're finding is it's better if you're basically multi-channel if possible. It's obviously pretty hard to roll that out. I think that's where also the higher the price point, the more you need a retail channel, then the lower the right price point, it's less risky for a customer. So I think that's what we're seeing. I mean, that's why we have wholesale, because wholesale helps us get out our product. And I think that helps. Now the offset to wholesale is you have the wholesale markup. So we kind of have two different business models right now. We have the business model where the Collegiate stuff we're talking about, that's actually more like a direct to consumer kind of Warby Parker type of play. So the price value equation is off the charts, and we're seeing that show up in the results in terms of sell through. And then our traditional wholesale brands, where we're selling through Anthropologie and big box retailers as well as boutiques and online. The boutique, though, world is shrinking a little bit, as you can imagine, in this market. So it's mixed everywhere, I think is the best way to say it.
Yeah, you definitely are the person to talk to about what's happening in this market. You are in so many different brand names out there, all in retail. And so thank you for sharing some of your knowledge in this industry a little more. I do want to talk about some more of that big picture retail right now. There's all this discussion about the Fed cutting rates. Is that something the retail sector is watching really closely right now?
I think probably secondary to tariffs. But yes, I think it's tariffs first, and then it is the Fed rate. But I think what they're really looking at more too is just really the health of the customer, because I think you're seeing credit card debt on the rise, which definitely puts a hamper on things. And then I think in general, what you're seeing too, and I think the retail industry is starting to understand this, is like the problem is like if you think of a hierarchy of needs, where someone's needs are, food is going to be up there. Food inflation's been really tough, right? So while a Fed rate cut might help a little bit, it's not going to change the fact that their grocery bill has been more and continues to be more. Credit card debt's on the rise. Then you also have look at how much pricing the streaming services have been taking. So then you look at that too. And so the problem is there's all these little headwinds into retail that just nip away at the wallet share for apparel. And then you have the best thing that's happening for apparel or retail too is this de minimis thing going away. So for the brands that relied on de minimis, which is that if it's under $800, it had no duty associated with it. And that was Shein, that's Temu, that's all these Asian companies that are sending in, or even like a lot of the European fast fashion brands too. They all relied on that. And then even a lot of DTC brands, direct-to-consumer only brands, even here in the US, what they would do is they would ship into a DC that sat on the Mexican side of the Mexican-American border or the Canadian-American border. And then, most packages aren't over $800. So it sat in basically, in essence, a duty-free zone under $800. It would ship and there's no duty. Well, for some of these products, it's on minimum 20% tariffs all the way up to like 35 if it's synthetic heavy. That's a huge benefit that these direct consumer companies had, and they were using that money and putting it into marketing, digital marketing, which then now that that's gone, that digital marketing spend goes away. And also the fact that you have now they have to pay this. So these brands that were like 20 million or below now, I think you're going to see a lot of fallout from all these different factors happening over the next 6, 9, and 12 months.
Yeah, so interesting and such a major impact from tariffs. It feels like we've been talking about this entire year, and there
Yeah,
still isn't really a true resolution, right? As
that's
someone
right.
who works in retail, is there still this level of uncertainty of what is to come the rest of this year and into next year?
It's country by country. So I think my understanding, Vietnam's locked it in. That a lot of production's done, especially for the big brands out of Vietnam. So Vietnam's the only one who's locked in. China, it's still going back and forth. And then India was just 50% the other day that got announced. Now that will, as we saw with China, go up and down and all these other things. So there is a lot of uncertainty. And the problem is it's hard to move supply chains. It's not like you just spin it up and off you go.
Right. Changing supply chains can take years to move or rebuild in some way. So retailers will absolutely continue to see the impact of tariffs. I think the biggest question here, though, is are we already seeing the impact from tariffs or is it still yet to come? Have we seen tariffs really reflected in earnings reports or in stock prices yet?
So the earnings you're seeing today, so most retailers are on what they call FIFO, so first in, first out. So they rushed product ahead of when they thought the tariffs were coming. So you haven't even seen the gross margin impact yet. You're not going to see that probably until next year because they loaded up on product under the lower tariffs. So think about that. So everything they're selling right now is still under the lowest tariff, but stuff they're probably landing starting this fall is going to be under the higher tariff. They were sold out of the FIFO stuff. So watch, just for all your investors, watch for that gross margin going the wrong way, especially as you get into 2026 because of the way just gap inventory accounting is done and how it impacts gross margin. So there's going to be a lot of gross margin pressure coming down the pipe for retailers.
Oh, that's such a great point to bring up for investors of what to expect, not just this year or right now, but looking ahead, the impact of tariffs long term, at least over the
Mhm.
next year, maybe the next 2 years. What do you expect to see in the industry? Do you expect to see a lot of retail stocks kind of struggling?
I do, because I think you're going to have margin compression because it's going to be one of two things. They're either going to have to completely offset tariffs, which I don't think is going to be possible. So that means they're going to be eating some. And then you're going to see pricing sensitivity by the customer as well. And so I think there's going to be some top line pressure. And then I think there's going to be some gross margin pressure. And then that's going to flow all the way down to the fixed cost side of the business. So they're going to have to right size their fixed cost. And then I think it's just going to be the other thing too is the consumer now. It's instant consumption. So you're also going to have to just get trends right. And I think it's just faster trend cycles than there's ever been as well. It's amazing how many years I've said it can't get worse in this industry, and yet it does. I think there's definitely some truth to that. I think you're going to see a lot of headwinds on the top line. I think you're going to see a lot of pressure on the margins, especially the gross margins. So because of that, you're going to have compressed earnings. And at the end of the day, stock market is just a big DCF, a discounted cash flow machine, right? So when you start modeling out, you're gonna see that your DCF's going down, which means there's going to be PE compression.
Yeah, so interesting. I also love the point about the fast fashion and or how quickly some of the trends are going right now too. I think as a consumer, you feel that there's
Yep.
constant changing of trends. So as a business owner, trying to stay ahead of that is very challenging. What are we seeing with CPI right now? Are we seeing consumers having that confidence to keep up with the trends? Are we seeing them pull back a little bit?
I think the problem is in apparel, they're pulling back. The CPI is getting consumed in groceries and other products and everything else. So I think we're going to stay in a state of inflationary. And the problem with that is going back to that hierarchy of needs. Your apparel hierarchy of needs is much, much lower than your other pieces of it. And so I think that's going to be constant pressure as well. And so I think what's going to happen is the consumer is going to have less money to spend because at the end of the day, apparel is somewhat discretionary, probably more discretionary than not discretionary, with the exception maybe back to school. But even then you're moving up and down, right? And so I think like if you look at Walmart's numbers, Walmart's held up. Target hasn't held up as well. If you talk to the Walmart, you listen to the quarterly calls, they're talking about how that customer is shifting down. They're seeing more 100,000 plus income households than they've ever seen. And I think that just shows you that the customers are saying, you know what? I'm okay now doing this. And so I think, you're seeing a lot of licensing happening in the industry. I think you're going to continue to see that because that's the safest and easiest way. We just announced a license deal in our queue with TJ Maxx for our Sundry brand because it's a great way to offset it. It's 100% cash flow.
Yeah, so interesting to have this conversation behind the scenes in retail and all of the moving pieces that go with it. I want to talk a little bit more about inflation and retail. We're seeing so much inflation in the grocery sector and in many other different sectors. Do you think that inflation is going to hit retail prices? Just speaking for consumers out there, do you think that we're going to start to see those price tags go up soon?
Yeah, so I think you're going to see it in a couple of different ways. Going back to that de minimis we're talking about for the Timu and the Sheins, they're going to have to really increase prices significantly. So you're going to see it there, which is actually a benefit, I think, to the middle, like the low middle market, like the Macy's brands and things along those lines, because now they're going to be more comparable. I think in general, though, you're going to see it because you just can't eat all the tariff increases. So I think what you're going to see is multiple years of just creep. And then the question is, then are they going to mark up because they're going to have to be marked down more too now, right? Which is what got Nordstrom's in trouble is the half yearly sales is like everyone got so used to waiting to buy on the sale. So the markup was higher, the initial markup, what they call the IMU, because the half yearly sale, they wanted to be on sale. So I think you're going to see a lot more promotion. I think you're going to see a higher IMU markup to mark down. And then I think in general, you're just going to have price creep.
Again, a really interesting inside look at what's happening in retail right now. I want to talk about your brand specifically and what's been happening in the different brands that you have. I know a lot of the brands in your portfolio swing a little bit more luxury. Are they holding up well in this market right now?
Yeah, so they've been okay. I mean, we haven't been crushing it by any means. And part of it is like, you just have a softer customer. We're very boutique heavy. So we've seen a slowdown in some of the boutiques, but it's been offset by the growth at Anthropologie, which have doubled their doors. And we're very excited about that. And they're having great sell through. So we've really leaned in there to offset that. And then e-commerce seems to be working, but it's definitely more of a promotional environment in e-commerce across the board as well. So you're seeing that happen. But the nice thing is in e-commerce, you have the margins, right? It's because you have the wholesale markup as well in there so you've got the really margins to play with. And I think more than ever, it's just getting product right. Now, I think there's just more of a focus there. If you have just another brand product or something that's similar, it's really hard to make a market. So for our brands like Stateside and Sundry, it's a competitive space. And we're treading water. We're doing fine. We're growing, albeit not as high as we'd like, but at least we're up. And then the question just becomes, especially like we just brought in new designers for both our brands, and spring was their first real season. So we're selling, to give you an idea in wholesale, we're selling spring right now. We've been selling spring for 3 weeks. Spring closes mid-October. So we'll know our bookings by mid-October for Q1. So the nice thing is it's checking incredibly well. We're seeing a lot of success there. And we're excited about that. And I think it's caused new designs and we really sharpened what the brand needed to stand for. So like Stateside, we sold a lot more what I'll just call everyday or evergreen, but now we're seeing a big push into novelty. For Sundry, our graphics continue to sell really well in colors. The designs got sharper, the novelty got sharper, and we're seeing really strong demand so far from early spring. We have the Avo and the Collegiate line, which we can talk about in a little bit, but that to us is where I think it gets really interesting because when you look at, we call it the Warby Parker for collegiate apparel. Like you think about Warby Parker and what they've been able to do to the industry, we'll get into some of those details there. It'll blow you away, like how many touches and how expensive a product gets. But by us going through direct, we're able to really create a strong customer value proposition. And I think at the end of the day, this is what it comes down to. What is your CVP? What is your customer value proposition? If it's same product, same price, everything else, there's no CVP.
Yeah, absolutely. Such a good point. And what sets companies like yours and retail especially apart? I'm curious, based on some of the conversation we had about what's happening in retail, what is your company, what are your different brands doing to kind of prepare for those changes that might be coming in the wider economy?
We're actually eating margin too, but it's offset, I think, by we're getting higher orders. So then we're getting price benefit there. So there is a little bit of headwind there, but e-commerce is doing really well. We're doing a lot more asset creation. We're finding that's really critical. And also both AI and non-AI. The AI is getting better every single 3 months, really. I mean, it's pretty amazing the evolution there. So it's a little bit of lifestyle, a little bit of AI. So you're kind of figuring out ways there. You're sharpening the G&A side of the business. So you're really looking at headcount. You're really looking at your expense and cost. And then I think the big piece is just continue to really lean in e-commerce because you can own and tell that story and really watching your ROAS. So, we'll increase, decrease, like it's every week. We're looking at the ROAS and where we need to be, and not only ROAS, but just repeat rate and things like that. And then I think the key is building a product that's relevant. We see it in our numbers. When you have relevant product that's on trend that people want, it's amazing. The price sensitivity is not there. The demand is there. So it really comes down to product.
And it sounds like the collegiate part of your business is where a lot of that demand is. Let's talk about that a little bit. And is this new for your company?
Brand new. We launched at the University of Alabama with some of the products behind me right now. In fact, we're launching this crimson color you see. That's going to be in our September drop. Well, what we're finding is the nice thing about it is they're buying the brand, right? They're buying the Alabama brand. They're buying these other schools that we're going to be launching as well. What we're doing is it's the same product that we're selling at Anthro and all the big box retailers. So it's this $70 tee. There's a tee right behind me there. That $70 tee, that's the same tee. It just has an Alabama logo on it. But at University of Alabama bookstore and at the Yay Alabama website, it's $28 because there's no retail markup.
Wow.
That's like compelling, right? And if you look at what's on the floor, like right now, a lot of this business is driven what they call the Chinese blanks. So they're ordering just a blank from China. Their cost, now this was pre-tariff, is $3 to $3.50 per shirt, right? That's what their cost is. And then they got to put the logo on it and everything else. But that shirt ends up selling for $45 to $50 at the bookstore and everywhere else, right? What ends up happening is we don't have those. We're going direct. And then we're able to drive this incredible value proposition. And to give you an idea, the cost in that t-shirt behind me right there is $5.95 in fabric. So our fabric cost, before you do cut and sew, before you get to do garment wash, is almost double what a blank is out of Asia. And by the way, that blank is duty paid, landed at the back door at $3 to $3.50. So that shows you the quality gap.
Talking about your stock, that's what our viewers care about is looking at
Yeah.
what this means for your stock price. So what does this new program that you've launched mean and what potential does it have for moving your stock price and really the value of your company?
Yeah, I think there's some really good comps out there. Fanatics in December 22 was valued at $31 billion. They did $8 billion in revenue. My understanding is roughly just from Scudder. I have no, this is just all sidetrack, but $5 to $6 billion in collegiate apparel revenue, and that's the white space we're kind of skating in there. And so so what you kind of got this driver here where we're growing and we have an unbelievable customer value proposition. So we are like, I think that's so critical. It's just owning price value, right? You own that and then you're going to continue to grow. And does it stop at collegiate apparel? Are you into other sports at that point, right? We're actually working with this great group called Legacy Sports Complex. They're going to be one of the fastest growing training facilities. They had a bunch of people that were drafted by the NFL. So they do 7-on-7 camps. They have these. They're still out of Atlanta. They're opening one actually in Southern Alabama, what we call LA, RLA, Lower Alabama, and then all these others. So we're going to be their exclusive manufacturer. So we're working on some performance fabrics with them, which will be really cool. And so I think what we're seeing is the demand is there because it's expensive to buy this stuff. So if you can come in with a much sharper price point, same product quality or better, people want that. So I think this is a huge driver for the top line and for margins going forward. And then just brand awareness. And then I think on our other businesses like Sundry, where we just signed that TJ Maxx licensing deal. We already have a deal with them with Bailey 44, which is one of our brands, but the Sundry is like 4 to 5x bigger. So that should really help with the cash flow, like really increase cash flow. Then you're also got Stateside just continues to perform. And I think the big thing, and I did equity research for a long time, what I think people lose sight of for investors, and it took me a while to understand this, is that revenue, it doesn't, like your costs don't grow with revenue because you get leverage. So for us, we've got a long revenue runway where we can continue to grow revenue without having to make major G&A investments. So that's going to increase flow through. And flow through creates cash flow, and cash flow creates all this other stuff. And I don't know if you saw, but in late July, we did a raise. We raised $15 million, and we don't need more capital. I mean this, like for the first time, and you're going to see the balance sheet clean up a ton and not need that capital. And I think that's a huge deal for investors because you're not going to have that overhang. And so what we're going to do is really focus on our current brands. We've been acquiring a lot of brands. We feel like we've got the right base of brands now. And really a lot of the money is going to go behind this Collegiate program because we're going to have some really amazing announcements coming out about this. And then we're going to launch this really cool rewards program that's not going to be about points and everything else. It's going to be about experiences. And we're a big believer in music and things like that. So you'll see that come into play. So I think this whole thing about this personalization and this customer value prop, whether it's in Collegiate or with Sundry, is going to be a huge piece for us. And that'll start rolling out in January. We're actually looking at facilities in Austin, Texas right now to build this whole thing where you can order on a Monday And by Thursday, you'll have your customized product, which I think is really cool.
I do want to share we have a link in the description right now. If you want to look at all of the brands included in Digital Brands Group, you can find that link right in the description. A lot of big catalysts coming for your company right now. That timeline seems like the most important one, launching this new brand and these new products in January. When do you expect that to really show up on your books and could really potentially boost the stock?
Yeah, so I think what you're going to first see is Alabama through this year, you're going to see that start to show up in the Q4 numbers because football season, I mean, it started week 0 was this past week, but the big games are this weekend, right? And so you're going to see, I think, the benefit of that flowing through September. So it'll have a slight impact in Q3, but Q4. And then I think you're really going to start seeing it happen in Q1 and Q2 and going forward, both on the collegiate side, but also as well on the sundry side with the customization. The other thing I think that's really important that's going to start to show up is for the first time in our history, we're not paying debt off. We're not paying interest expense and all our legal fees and like for S1s and filings and all acquisitions and all this, all that now for the first time as of the end of July is behind us. So now we shift from how do you survive and pay off the debt and all this stuff to growth mode. And then the question is, what are your growth drivers? Collegiate, sundry, anthro, and the customization program for sundry as well. So you have growth drivers on top of the fact that you can invest behind these growth drivers. And we've never had that in our history.
It's an exciting time for the company for sure. Hill, thank you so much for your time today and for sharing more about your company and what's happening in retail in general. It's a lot of great information for our viewers.
Absolutely. Thank you for having me. And I'm happy to join whenever you need me.
All right. Sounds great. Thanks again. And thank you for watching today. Let us know what you think in the comments. Are you into retail stocks right now? Are there some you're watching a lot? Are you familiar with the brands that Hill is talking about right now? We'd love to hear from you in the comments. Thanks again for joining us, everyone. And as always, happy investing.